Hello, good evening. How are you all? So today we will go through this paper from BIS, Bank of International Settlement. This is a paper on shadow banking on Bitcoin, basically on cryptocurrency and Bitcoin, and it's about their views on the cryptocurrency market, about regulating them, about participation of the formal financial system in the crypto market, about the risks involved and what needs to be done, what's currently happening and what needs to be done in the future, some of the recommendations they have made to the central banks of other countries. So it's a very interesting paper. We will go through this paper. Please like the stream if you if you like to support us. Thanks for joining in. If you have questions, please let me know. I think it will be a good discussion if you ask me questions in the chat box. Alright, so the paper, the title of the paper is that it's banking in the shadow of Bitcoin, and it talks about the institutional adoption of cryptocurrencies. Institutional adoption means whether the formal financial system, banks, non-banking financial corporations, insurance agency, government agency, public sector firms, which are regulated by the government, will they ever adopt cryptocurrencies? They have started, not to a large extent. We will see more in this particular paper about the data that we have on how much is the formal financial system, which is regulated, is participating in the crypto in the crypto market, and whether it poses any risk and how the future looks like. And we also like to understand the viewpoint of the regulators. By the way, they are very positive about it. The authors in this paper are working with the BIS, and they are quite positive about cryptocurrency. And one of the view is that sooner or later this is going to happen. So why not recognize them and have regulation guidelines in place like for other financial assets. Alright, so we'll go to the abstract, which goes like this. The phenomenal growth of cryptocurrencies raises important questions about their footprints on the financial system. What role are traditional financial intermediaries playing in cryptocurrency markets, and what drives the engagement? So this exactly is the question they have answered in this paper, as to what exactly are financial intermediaries, which are the banks and the insurance company, NBFCs, different institutional funds playing in the cryptocurrency market. How are they participating? Are new nodes emerging? Are there some new trends to see? We help answer these questions by leveraging a novel global supervisory database of banks' cryptocurrency exposure. So what they have done is that they have analyzed a data set which contains the exposure of different financial corporations such as banks towards cryptocurrency, right? And by synthesizing a range of complementary data sources for other types of institutions. So for financial institutions, data is available to them because financial institutions are required to report on their exposure. So the BIS, which is the international regulator in some sense, is having the information on that. But for other kind of institutions which are not directly regulated, they have used some alternative data set. Across, we find that major banks' exposures currently remain at a very modest level. So most of the banks have very low level of exposure still on cryptocurrency. Across countries, higher innovation capacity, more advanced economic development, and greater financial inclusion are associated with a higher likelihood of banks taking on cryptocurrencies, which is quite expected, right? Wherever you see higher innovation and very tech shabby banks, such as the big banks of the Europe and the US, are the ones which are participating in the crypto market, and they have some exposure towards cryptocurrency, but not the other banks. For example, the banks from the more less developed countries. We saw that substantial activities is concentrated in lightly regulated crypto exchanges. Concentration is a point to be noted. The shadow crypto financial system serves both retail and institutional clients. Retail clients like you and me, right? Normal people, and then you have institutional clients such as the banks and NBFCs, mutual funds, and all kinds of funds, hedge funds included. There are many crypto hedge funds, right, in the world, especially in the US and in many European countries, such as dedicated investment firms. Yes, there are dedicated investment firms in crypto space. I'm not sure whether doing well at the moment or not, but we have dedicated crypto funds in London, for example, in New York. Okay. An uneven regulatory treatment across banks and crypto exchanges, and significant data gaps. So uneven regulatory treatment means regulation differs a lot across banks and exchanges, right? First of all, there is hardly any regulation, but little bit of regulation is still there. It differs a lot with respect to country, with respect to banks and all this. And there is also a significant data gap. That means unlike the formal financial system where you have tons of data to analyze, you don't have much data to analyze this very proactively. All right. So it should focus on ensuring a more level playing field with regards to financial services provided by established financial institutions and intermediaries in emerging crypto shadow finance system by introducing more stringent regulatory and supervisory oversight for the latter. One thing that is crystal clear from the regulators is that should be more stringent regulation. For example, disclosure, right? Banks are supposed to disclose a lot of the information to the regulators on a regular basis, without which banks will lose the license to operate. That's not mandatory for crypto funds, for example. But in varieties of ways, if these institutions do not disclose their exposure and something bad happens, then a lot of these funds will go bust, and with them they will take down also other institutions such as even banks, although many like the big banks are not too exposed to crypto, but there are still concerns that where you have sort of less regulations in place in case of banks from emerging economies where they're not very well regulated, in many countries. Okay, we'll go through this paper. We will take the most important points in this paper. Let me know your thoughts if you're watching. Hi, good evening, guys. Please like the stream in case you want to support the stream. Thanks for being there. The past decade has been phenomenal in terms of how the cryptocurrency as a financial instrument, as an instrument that can be used in place of money or a formal asset. It has really generated a lot of interest among people. It started quite some time back, but I think in the last few years things have changed quite drastically. And obviously the decentralized finance, which is actually the more of an infrastructure for the cryptocurrency market to which is very important to understand about decentralized, right? It's not centralized, unlike the formal financial system where central banks are regulating. So the general public is quite interested, not just general public but also businesses and financial market participants, CEOs, and even the CEOs of the banks and insurance companies. They're also quite interested to know what's going to happen, whether this is going to pose a threat to their business or not. All that all that has happened in the last decade or so. Investor in search for alternative investment opportunity in a low yield environment. What is noteworthy is low yield environment, because in the recent past we have seen in the last few years stock markets have been doing well, but for quite some time stock market haven't been doing well. Bond yield was low, so people were exploring alternate opportunities to invest money, and that's when speculation happened that crypto could do very well. And thanks to social media, where many social media people are also spreading this information, sometimes misinformation about crypto, and so general public therefore is very interested in this instrument. Ample anecdotal evidence points to rising investment in cryptocurrencies and supporting technologies by non-banking financial corporations and new financial startups. So there are like countless non-banking financial corporations and new financial startups engaged in crypto, right? Many of them. Moreover, the emergence of exchange traded fund ETFs for Bitcoin. Now this has been innovation, right? You have ETFs now even for asset like Bitcoin, and relative derivatives could pave the way for further investment engagement. So derivatives are used for hedging, right, to manage your risk. Now if there are ways you can manage your risk, so you'll be even more interested to invest in the crypto, because you can mitigate your risk by buying some sort of an insurance against the downside risk, right? And that's derivative. So if those things are going to happen, so there will be even more interest. And more recently, the war in Ukraine has further sparked interest in cryptocurrency and raised questions about regulation oversight. So here you see the capitalization and growth of cryptocurrency and its market volatility. Just imagine how much it has increased in the last 3 or 4 years, so right? In 2018 it was less than 0.5 trillion US dollar. Even until 2020 it was less than 0.5 trillion US dollar, and now it is by 2021 it reached 2.4 trillion US dollar. That's like a growth of 6 times, or even more than 6 times, because I think it was somewhere around 0.3, so it's about 7 to 8 times in just a matter of 2 years. It's come down drastically, by the way, I think thanks to, because crypto, most of the cryptocurrency are not doing well in the last few months. So there is a bit of a problem there. There's a market crash there, but otherwise, even with the market crash, you still see a huge increase in the market cap for crypto. A number of active currencies, cryptocurrencies, right? They used to be barely like 30 or 40 in 2014, and now it's like you have more than 8,000 cryptocurrencies actively trading now in the market. And you see the volatility here, right? Whether it's Bitcoin, the important ones, Bitcoin, Ethereum, and there's a comparison with S&P 500, the market index in the US, gold and bonds. And what you see is that Bitcoin is the red one, right? Just look at it, the volatility, right? Even Ethereum, which is another cryptocurrency, is quite volatile, right? The blue one and the red one, you see there is a massive volatility, whereas gold and S&P 500 bonds, they're not at all volatile, right? The standard deviation is very close to 1 or 0.1, less than 0.1 in fact. So that's about the growth of crypto in the last decade. Against this backdrop, the public sector has started to consider possible implications for financial stability, right? Which is quite reasonable, right? Most people will think what kind of impact it will have on the formal financial system. Our formal financial system, like banks, are having an exposure to this volatile assets, because volatility means riskness, right? The assets are quite risky, as you saw right in the previous graph, that there is massive volatility in the crypto prices. So you can expect that it's a very risky asset, and banks are not supposed to hold these risky asset, because otherwise if something happens, the bank will go bankrupt, and people will lose deposits and so on and so forth. So what is important to understand? The prudential framework. Prudential means government or central government or state government, provincial government, or even at international level, which is the Basel committee, right? Basel committee. Are there regulations in place? Should there be regulations? This is an important question too. Increasing investor demand for cryptocurrency also raises the question of how the resulting rise in demand for intermediary services will be met by financial institutions, because since retail investors are quite interested in crypto, so what will be the role of the formal financial system as an intermediary? I mean, not as as an institution that is engaged in transaction activities, as in investing money in crypto, but as an intermediary. If you want to buy crypto, obviously you will be using your bank account, right? Whether that is legal or not, whether that should also be regulated or not, that's still a question. Has the growth of cryptocurrency activity over the past years occurred primarily within traditional nodes of financial system, such as banks, or has the emergence of new nodes, most notably new exchanges, facilitated the boom in cryptocurrency? So the boom is now we have new exchanges where buying and selling is so easy now, right? You have mobile apps using which you can buy and sell crypto without having to worry about it. But if you are buying it using your money, right, your US dollar, euro, or rupee, or any other country, a pound, any other currency, you really have to use a bank account, right, which is a formal financial system. How is that going to play a role, and what regulations should be in place? What controls should be? All that has been discussed in the paper, but also importantly, these are very important questions to ask. We find that banks' direct exposure to cryptocurrency has remained very limited. So formal financial system do not have a very big exposure to crypto. Some banks are considering even more active role in the providing cryptocurrency related services in the future. So this has been a study by Bloomberg, and they have interviewed many banks, and they got to know that many banks are interested to participate in crypto related activities in the future. Yeah, for now, as we speak, in 2022, this paper came in May 2022, by the way, right? So the average exposure amounting to less than 0.02% of the bank's risk-weighted asset. So of the entire RWA, you just have 0.02, which is very, very low. But for big banks, right, banks having total balance sheet of over $1 trillion, this is still quite significant, by the way. And no bank reporting exposure greater than 0.5%. So average is about 0.2%, but none of the banks have exposure greater than 0.5% of RWA. We also find that such exposures are primarily in response to growing client interest. So it's not because the banks themselves are interested, it's because of some of the clients are interested, so they have to participate in this. We saw that flip side of limited adoption by banks is dominant role for novel crypto exchanges. So because banks are not participating, the exchanges are actually playing a dominant role. Now question is whether exchanges should be regulated. That's the question. So if you don't do that, then there's someone who is actually going to do that and take advantage of it. It's not going to be good. They provide platforms on which participants can trade and store cryptocurrencies and remain largely unregulated, which is a concern, right? The crypto exchanges are not regulated at all, essentially forming a shadow crypto financial system. Shadow because everybody knows it exists, but you can't control it because it is not a formal financial system. So compared to existing regulated exchanges for traditional financial assets, right, all the exchanges around the world are well regulated, right? Whether it's New York Stock Exchange, whether it's London Stock Exchange, Tokyo, or anywhere in the world, they're very well regulated. But none of these crypto exchanges are regulated. Some of them even have gone for IPOs and all in the recent past, but there's no formal financial regulations for these exchanges. The regulatory and supervisory oversight of crypto exchanges encompassing consumer protection, market integrity, trading, disclosure, prudential, and addressing anti-money laundering. Yeah, so so why we need that? Because first of all, consumer protection, market integrity in the market, everything is so transparent, has to be transparent. Trading, any kind of trading should be transparent, and you must have some sort of regulation in place. And disclosure, right? This is a requirement for all public entities, including the banks and insurance companies. So why not this this crypto exchanges and prudence, all kinds of other things, for example terrorist financing, anti-money laundering. Okay, where were we? Yeah. Or financing, terrorism, for example, all that has to be properly regulated. Otherwise, people take advantage of it. Rising number of crypto investment firms has begun to provide institutional investors and retail investors a gateway to obtain exposure to cryptocurrency. Asset under management has thus grown significantly since 2020, albeit starting low levels. So because you have crypto investment funds also, which are institutional investor, even they are giving opportunity for retail investor to participate in proper investment. Basically hedge funds, right? They're managing money on behalf of the clients. Banks are not doing that. So we need investigate the cross-country drivers for banks' cryptocurrency adoption. We evaluate a broad range of potential drivers based on formal regression setup. We find that banks domiciled in economics characterized by higher innovation and capacity and more advanced financial development have been likely to engage, which we have discussed, right? It's happening more in the developed country. It started as a substitute for fiat money, right? That's why Bitcoin was started. But a number of central banks officials have argued that the rise of cryptocurrency and centralized finance raises fundamental questions about the nature of trust and money in the digital area, because the purpose is exactly the same. So question is how to formalize it. Our findings, however, suggest that footprint of the current generation of cryptocurrencies does not mark a sharp depart from the existing financial system. You can, I was in Germany and I went to this coffee shop. I told them, okay, do you use a card? Can I pay by card? He said, no, either you can pay by cash or pay by Bitcoin. I was quite surprised actually. So Bitcoin is a replacement for cash. I was super surprised that this is happening even in coffee shops these days. So it's not very different from the formal financial instruments when it comes to transaction, right? It does the job. Instead of relying on the trust-free that is on chain environment, a new set of agents has come to the fore that is offering convenience, market access, transaction scale, liquidity to these markets in such a manner as a commercial banking. So what the authors are saying is that it's doing the job. So there's nothing wrong with the concept of cryptocurrency. It's just that the way it has come about and the way it is the way no countries are regulating that, and it is becoming an issue, the fraud cases and everything which are happening. But as such, it's not a problematic thing. Digital currency is still quite a good thing. If governments will have their own digital currency, it's a different question, and I think everyone is looking forward to that. But then that won't be very different from our actual currency, right? So the whole point of having a decentralized financial system is not to involve government or central banks or anyone in this kind of system. Our analysis has three policy implications. First, a new set of market participants consisting of crypto exchanges and ancillary entities has arisen that deserves closer regulatory and supervised scrutiny, which is, I think, absolute must. There must be closer regulatory and higher scrutiny. These new intermediaries not only serve retail clients but also institutions such as hedge funds and investment funds. Right? Many hedge funds are quite heavily invested in these financial assets. If they go bust, I think it will have implications not just on these firms but also on the formal general economy also, indirectly if not directly. So that's one. The second thing that they would like to recommend the authors is to address data gaps. Right, in the industry, there's absolutely no data on the crypto assets, but you have such data on all kinds of loans and bonds and stocks and everything, right, in a formal financial system, but nothing really is there on crypto. So you really can't do much about it without having any data. The third point from the authors is that the potential for many interlinkages between cryptocurrency intermediaries and the mainstream finance system requires a comprehensive approach to assessing mitigating risk. So if there is a link between banks and crypto exchanges, this has to be properly, the risk should be mitigated. There must be higher scrutiny. So they foresee some sort of a pressure on the financial systems, the banks, which are regulated, by the way, but they would also be interested to provide services because that's for their own benefit, but that imposes some risk and that has to be mitigated. Left unaddressed, this evolving landscape would see conventional and restricted intermediaries relying on a crypto shadow financial system. If there is no regulation, so what the regulators are saying is that if there is no regulation in place, then what will happen is that the exchanges will take advantage of it, and there will be a shadow financial system. It's not a formal financial system. It is not being regulated. It's not under anyone's control, but it's a functioning system, and maybe a tiny fraction of a society taking advantage of that, and which is not good for the whole society. So what they are saying is that better to have one rather than not having one. While cryptocurrencies have originated from the outside of traditional financial system, risk from cryptocurrency could easily transfer to banks and other established financial system. You cannot ignore it, because the risk might generate at some other institution, but that may have a spillover impact on the formal banks and on the general economy. So these things are recommendations, therefore, just to have or recognize them, have regulations in place, ensure that there is more data to analyze and to sort of use the data for better policy making. And even these things can be done not just by the central banks, but also by the respective governments. Alright, so we have learned a lot of things. Yeah, a few more details before. Yeah, for example, they have recommended about using the accounting rules of the US GAAP. In accounting rules can be another factor. I think that has to also be the accounting rules should also take into account how they will assess the crypto assets. For now, it's considered intangible asset, similar to intellectual property. As a result, unrealized gains due to an increase in the price of what Bitcoin cannot be accounted for on the investor's balance sheet. This contrasts with the unrealized gains on shares of investment funds that invest in cryptocurrency relative to direct. Okay, so many people are taking advantage of that because that is not accounted for in a balance sheet. People don't show that as a profit. So I don't know, maybe it has some tax implications also. Relative to direct holdings, investment via funds also allows investors to rely on the established infrastructure that are subject to broader regulatory and supervisory oversight. So these are graphs. Investment funds providing a gateway to institutional adoption. Cumulative net flow is well above $10 billion. So this is purely from the investment funds, and you have asset and management also well above $30 billion. Okay, and there are number of Bitcoin funds, specialized Bitcoin funds. Now there are over 15 of them. Banks reside at the core of the financial system and thus provide a natural starting point for the assessment of the institutional adoption of cryptocurrencies. Exposure to the cryptocurrencies ecosystem could rise from a multitude of direct and indirect interlinkages. These include activities such as direct insurance and ownership of cryptocurrencies, intermediation services for customers who seek exposure to asset classes. Okay, so this they have discussed this point again and again, but we'll see some of these graphs. Banks holding cryptocurrency. 66 banks were surveyed. Banks in monitoring exercise. Okay, not 66, sorry, about 66 plus 112, which is about 178. So banks in monitoring exercise, banks in crypto exercise, banks with crypto exposure. Okay. And then you have size of the banks. I think they haven't taken the very big banks. These are some mid-sized banks. And this is how you have the exposure, from trading client accounts, clearing futures, providing custody service for wallets and others. Okay. At least they're not investing money, as in they're not trading their own money, I think, which is good. Banks with cryptocurrencies appear to be limited to a few jurisdictions. Right? Only in few countries it is happening. It is happening in the US, in some South American countries, in Europe. So it's predominantly US and the Europe. But there are some African countries also involved. Australia is as well. New Zealand, Singapore goes with Japan, South Korea as well. I think some Middle Eastern countries also, Dubai and those places also. There is a lot of interest there. But I think most of the developing economies, emerging economies, are not participating in this. Russia, for example, China, the banks are not participating in crypto activities. They don't have any exposure there. Russian banks or Chinese bank, Indian banks, they're not. South African banks, they don't have much exposure. Volume of bitcoins held at exchanges. Just look at the growth. It was quite low. So these are first of all, the growth actually is quite massive, but you also see the distribution across various exchanges, Coinbase or Binance, these Gemini, these are some of the famous ones. Coinbase being the leader, I think 1/3 of transactions are happening there. So that the first one was about Bitcoin, this was about Ethereum. And you also have stable coin holding, which has gained prominence in the last 2.5 years. Stablecoin is actually, a map with the real coin, US dollar, so that to reduce the volatility. So okay, so the massive investment. Okay, so even though in China the banks are not participating, banks and Chinese and Russians are equally participating quite heavily, right? You see China here, and also Russia, US goes without saying, quite heavily. So this is more about turnover. So investors are there, even in China and Russia, but banks are not participating, including India, right? In India, banks are not participating, but people are participating. People are investing money. I think it's less happening in Africa, which is a good thing. But else, almost everywhere in the world, it's so this is the growth in the institutional investors. So it's not that even the retail investor have shown tremendous interest after the pandemic. Even the institutional investor have shown tremendous interest. For example, even some of the companies, for example, Tesla bought $1 billion of Bitcoin, and many other companies I think bought. So and then you have online search interest across time, regions, and cryptocurrencies. Yeah, so most people. So Nigeria is topping here, followed by South Africa, Ghana, Australia, Austria, Netherlands, Singapore, Switzerland, Slovenia, Australia, and Canada. Okay. Interest in Bitcoin dominance. Again, Nigeria. All right. Wow. So why people in Nigeria are searching online more about about crypto and Bitcoin. Interesting. Although there's transactions happening more in the developed economies. About currency, US dollar here, the yellow. What is CNMY? It is a Chinese currency, I guess. Okay, maybe I don't know. And there was some regression analysis, obviously, right? This paper has been written by economists, so economists love to do regression analysis, so they have done some regression analysis also. What is the dependent variable? Share of respondent banks with crypto exposure, total crypto exchanges turnover per country, and there are many independent variables such as cryptocurrency legal status, central bank digital currency project. Oh, there are many of them. What are they trying to understand here? Okay, so they are interested to know the drivers of crypto exchange turnover. What are the drivers? Okay. Okay. So these are the drivers, these are the factors. Public interest, digital infrastructure, obviously, right? Wherever you have better digital infrastructure, whether it's China, whether it's US, you have more transaction happening there. Mobile cellular subscription goes without saying, again, in developed economies or in large size emerging economies such as India and China. GDP per capita, for sure, right? It's more happening more in developed economies, remittances and all that. So these are, expected drivers, so not surprise. So what are the policy implications and conclusions? We will go through this. Developments in cryptocurrency market continue to evolve at a fast moving pace amid continuous efforts to develop the crypto ecosystem and expand the range of its business applications. It's quite obvious, right? This is happening. As a result, cryptocurrencies have attracted significant interest among various financial market participants in the recent past. Financial innovations linked to cryptocurrencies and their infrastructure are also argued to hold the promise of significant advances in payments, trading and other financial intermediations. The positive side of crypto, right? As I mentioned about, visiting the cafe in Germany where people asked me about whether you can pay in Bitcoin. I was quite shocked to know that. Notwithstanding rising institutional investor interest, we find that major banks' exposure to cryptocurrencies appeared limited thus far. Quite low exposure of traditional banks to crypto is quite low, still quite low. A novel supervisory survey suggests that banks' exposure amounts to less than $200 million in 2020, and that's combined, okay? And that's largely related into trading on behalf of clients, so it's not their own exposure. First, the ongoing digitalization of finance and interest in Defi could spur the growth in and systematic risk of the crypto shadow financial system. While market activity had started from a relatively low base, the growth and trends over the past years underline the potential for cryptocurrencies and other forms of digital money, such as stablecoin and central bank digital currencies. I don't know if there is already one central bank digital currency, but that's been in discussion for some time to scale up quickly and become widely used. So what is needed is to need a forward-looking approach to regulating and overseeing such markets. Right? So it's good to already start. That's their suggestions. But they're positive about it, right? They don't want to ban them. So that's the message they're giving. Cryptocurrencies and intermediaries, including crypto exchanges, should be subject to same type of regulations and oversight as economically equivalent asset classes and institutions, including regards to financial stability, consumer protection. So whatever things are happening for the banks, for example, banks have to disclose numbers. They have to have proper scrutiny on everything, right? Whether it's consumer protection, whether it's anti-money laundering, terrorist financing, all these disclosure requirements should also be put in place for these exchanges and funds involved in crypto. While most currencies have originated from outside the traditional financial system, risk from cryptocurrency could easily transport to the bank, which is important, right? So it can have repercussion outside of this, institution participating in the crypto market, but also even the formal economic system could be collapsed because of something bad happening in crypto. Hasn't happened yet, but you never know. So what they're saying is the banks and asset managers could potentially be exposed to cryptocurrency through directly and indirectly. So that's the point. And third, data gaps risk undermining the ability of authority to oversee and regulate cryptocurrency. Historically, there's no data, right? For banks, there's a hell lot of data, although of not good quality, but they have historical data to analyze things and to analyze clients and everything, but there's none of that is happening, right? There's no requirement of it actually, although I think digital data is easy to collect and store compared to banking data, which was not digital a couple of decades back. While some of these blind spots reflect the decentralized setup of cryptocurrencies, there is scope to enhance the systematic collection and publication of cryptocurrency data in more rigorous and robust manner. One option for such framework is embedded supervision, which harnesses information in distributed ledger based finance. The aim is to increase the quality of data available for supervision, reduce administrative cost for firms. Yeah, so this can be, the data collection is much easier actually if it is totally digital. It can be automated so that administrative cost for regulators, not regulators, administrative cost for the firms can be lowered, and regulators will need that data on a regular basis. Okay, so these are some of the points. The BIS, the Basel Committee, doesn't take the ownership of these views. By the way, these are views of the authors themselves, but they have, these are people working in the bank. So that's the view, means that's the view of the organization also. It is being put very politically, but it's not very different. All right, thanks for joining in, and see you next time. Good night, guys and girls.